We are back with the HubScale podcast, where we dive into the minds of security leaders all around the world. This week, we have Karan Bhople. He ventured into security with SentinelOne, being there for 4 years and taking them public. Now he's the CFO of StrongDM. I'm really looking forward to diving into a lot of these topics today. Karan, it's great to have you on.
Thank you, Elliot. It's great to be here.
Yeah, no problem at all. So I guess for everybody listening, it'd be great to dive into just a quick introduction to yourself.
Sure. So as you said, I'm the CFO of StrongDM. We're a private company funded by Sequoia and Tiger Global. We do privileged access management, or PAM. This is my second cybersecurity company. Before this, I was at SentinelOne, which was quite a ride. I was there for 4 years. I joined when the company was relatively young, and when I left, it was public. And that was my first cybersecurity company, and I developed a liking for the space, a deep interest for the space. It allowed me to meet a lot of new people and travel quite a bit. And I think, regardless of what happens, cybersecurity will continue to be a highly needed service, a highly needed market. And it's dynamic, it's changing all the time. And so what happens today is not what's going to be happening in the industry 10 years from now or even 5 years from now. And being a CFO in the space, funding companies, planning their operations, managing their operations, I'm exposed to it directly. So it's a lot of fun.
Yeah, no, I can fully imagine. I can't wait to dive into some of these topics today because the CFO view on a lot of things is super interesting to myself, number one, and a lot of the listeners as well. So really excited to dive into some of these topics. But before we go into the topics, I'd love to dive into a little bit about your background. Obviously, you've been at obviously StrongDM now, crazy ride with SentinelOne. But take me back to the early days.
Yeah, well, I'm an unusual choice for a CFO, I guess, because I studied engineering in undergrad, but then I moved into doing finance within corporations right after school. So I guess the time I spent doing undergraduate research, where most of my experiments didn't work, gave me the indication that I didn't want to do that for the rest of my life. And I wanted to work with people, and I was good with numbers. So that combination kind of drove me into finance, but within corporations. And so my first job, interestingly enough, was at a company that had very little to do with cybersecurity. It was the Walt Disney Company. And I was there for almost 3 years. Disney has a strong finance organization, and they like to hire young people and kind of groom them. So I was there 3 years. I lived in LA. I learned a lot. It's an interesting place to work, a tough place to work, but you learn a lot. And because I was from the San Francisco Bay Area, after my stint in LA, I moved back to the Bay Area, and I got in enterprise software. So I worked for Salesforce for a little bit, and then I worked for private companies. And it wasn't until the third private company, which was SentinelOne, that I got into cybersecurity. And for me, it's interesting. When I was at Disney, I worked in the theme parks and resorts division. And that kind of business requires a lot of high CapEx, a lot of capital investment. The payback period on your investments, whether you're building a theme park or building a cruise ship, or launching other experiences, launching hotels and whatnot. There's a high fixed costs, high capital investment, and then a long time to return. But if you get it right, you have very steady cash flows, relatively steady cash flows, and if you do it in a way that builds your brand, then it creates goodwill across the rest of your portfolio: movies, music, consumer goods, consumer products, etc. And so when I moved into software and enterprise software, where you don't have a supply chain, you don't have high capital investments, you have steady OpEx, but you can have high returns pretty quickly. Your payback period is a lot shorter. And so that's, I think, why a lot of investors are interested in software, and a lot of VCs concentrate in that space. And that was a whole new world for me, like moving into that direction. And it got me excited because it was possible, when you work in that industry, in this industry, to work for many more companies over the course of your career and learn quite a bit more. And one of the things that I've learned over time and I've learned to appreciate is balancing being in one place or being in one company for a while with the ability to adapt to different environments and to showcase that adaptability. Because ultimately, the CFO, and now that I'm a CFO, I appreciate this. The CFO has to be a strong business partner to their CEO, their board, and their investors, as well as their employees and their suppliers and customers. And so, being able to do that in multiple environments versus one for a really long time is a strength that I've come to appreciate.
Yeah, no, and I can imagine the excitement going through all these different changes throughout your career as well, Karen. But I really want to dive into a few things today, and we're going to maybe talk about more about that career journey in a little while. But I want to talk about kind of the market conditions because a lot of the communication that I have with the clients that I work with or people in the industry is always talking about what is happening in the market. So why not go to a CFO who's dealing with the numbers on a day-to-day basis? So tell me about the market conditions right now.
Yeah, well, the market conditions have been rough for about a year now. I think what if we go back in time, maybe to the start of COVID, so 3 years ago, when COVID busted out of China and started impacting America, and then we had a mini market crash, as everybody would recall. But then the markets recovered, and I'm talking about the equity markets. I'm talking about and other kinds of markets. But I remember at the time in March 2020 when that happened, the Federal Reserve, they removed the reserve requirement, and so made it a little bit easy on the banks, tried to get more liquidity in the system to ensure that the economy wouldn't just crater. And I think some people at the time were making predictions that, okay, now we're going to start this difficult period. It didn't happen. And it didn't happen, especially in tech. It didn't happen because tech recovered very fast. And not only that, but the changes to day-to-day life in terms of quarantine, remote work, limited travel. And then as that changed over time, that actually empowered tech to provide new solutions or to refine their existing solutions for the market and continue to make money. So that call in early 2020, that prediction that, okay, now's the time when things are going to be tough, was premature. We had to wait a couple of years for the real turn in the market where things got rough. And in my opinion, from my perspective, the reason they got rough is because the central banks, but especially the Federal Reserve in the US, took way too long to respond to inflation. And people, just like economies and just like individuals, societies and economies, don't respond to shocks very well. And so I think at some point the Fed realized that they dropped the ball for way too long, and they ratcheted up interest rates, making the cost of borrowing higher, making the cost of capital higher, changing the way where people invest. That dried up money for venture capitalists, that dried up money for growing unprofitable tech firms. That was a shock to the system. And I think now we're at a point where people are wondering, okay, are they going to continue growing rates, or are they going to keep them flat and we enter a period of steady state, or something else? And I think some people are telling me now that there's a bit of an inflection point. I was reading some literature over the weekend that said that some startup valuations are starting to climb back. The multiples are starting to grow again. They used to be, 2021 multiples, or they're approaching 2021 multiples. I'm not sure I believe that. I think it might be a small sample size. We'll have to wait a little bit longer. But the reality is, I think we have to expect that this market will continue at least for the rest of 2023, and perhaps sometime in 2024 it recovers. If it recovers, and when it recovers, it won't recover in one day. It'll take a while, because unlike some past economic economic crises or not or recessions. This one has many factors. So in 2008 to 2011, the Great Recession, if you will, that was created by bad securitization practices by banks with respect to mortgages. And as a result, that was kind of a weapon of mass destruction that blew up. It freezed the credit markets. Capital became very hard, and things were rough for at least 3 years. But it had a specific source, and it had a specific ground zero that then spilled over into a lot of other areas. Um, this one has several factors because it has a combination of an inflation, it has a combination of geopolitics with respect to oil and energy and what's happening in Russia and the Ukraine and for that matter, what China is doing. It also has some bad fiscal and monetary policy that's causing it. A lot of spending, a lot of overspending, so to speak. And it also, part of it is also problems with supply chains and supply curves moving to the left because of increasing scarcity of certain things. So a combination of these things, I think, is causing the markets to be where they are. And so unraveling it, unlike what happened, one of the responses to the Great Recession was the Obama presidency, the Obama administration created TARP, the Troubled Asset Relief Program. They bought a lot of toxic assets. They had specific things that they could do because the crisis was financial in nature. I think this one, because of the many different reasons that I just described, it's hard to push one button and unravel it. So because of that, it's going to take longer. And I think people like me and people in cybersecurity and people in tech more broadly need to be aware of that.
When we was talking previously, you mentioned about three different areas in different markets. I'd love to hear your thoughts on that as well.
Yeah, absolutely. So in my job, and I think in not just in my job, but people who run tech companies and people who are corporate executives need to keep in mind the three markets that they need to be on top of are the product market, the capital market, and the labor market. So we can talk about each of those. So the product market is what your company does, what your company offers, how your company makes money. And as a CFO, especially, what I have to think about is um, how big is that market? That's the first question. The second question is the market growing or is it stagnating or is it declining in size? And then the third is where does my company fit into that market? And how is my company positioned? How strong is my company? What are the competitive advantages that my company has for the market that it's chosen? And all of those things are important, not just for me and for my management team when we're running the business, to improve our revenue, to improve our sales, to get to grow, and to take advantage of the things about the market that are beneficial. But it's also important to investors when we fundraise because investors want to know the same answers to the same questions. So that's the first thing is the product market. And in tech, many of the products offered are complex, they're technical. Not everybody understands them, but that's okay. It's a bit like when you're driving a car, you don't need to understand every single part of how the car is built and how it comes together. You just need to know the basics about how to turn the ignition on, how the gears work, how to read the dashboard, and how to move it around, and how to accelerate, and how to change lanes and turn and reverse, right? So you don't need to know, I don't need to be able to be an expert in how the car is built to drive it. And just like that in tech companies and tech products, you don't need to know how everything is built to understand how it works in the broader marketplace and how to navigate. But you do need to understand where your company stands so that if the market changes, you have some ability to predict where your revenue is going to go, where your costs are going to go, and where your company is going to go. The second one is the labor market. And the labor market is another one that executives and especially CFOs need to keep in mind. Because as you mentioned earlier, a lot of companies are still hiring. Some companies are laying off. It's a mixed bag. No company works without people to work for and for people to run it. And I think the labor markets, especially post-COVID, have been quite interesting because you have a combination of people moving around because they're more mobile because of the remote work that has become a trend. You also have I think people who have been graduating, finishing school in the last 5 years or so, or entering the labor market in the post-COVID world, in a world of high interest rates, and in the world where the markets aren't great in general. They need encouragement, they need guidance, they need good leadership. And so, as a company leader, one of the important things that I do, and the important things that my management team, the peers in my management team do, is hire good middle managers to lead younger people. Because it makes a world of difference for people who are starting their careers to have good guidance versus bad guidance, and good leadership versus bad. And I think when people who are at the start of their careers are encouraged and are motivated and are empowered, they are people who will follow you across your next several companies. So the labor market's important to understand because they are human relationships at the end of the day. It's also important to understand that because of the way education has changed and the democratization of education, the democratization of training your labor force, people 20 years ago, 15 years ago, they had to go to certain kinds of schools to learn certain kinds of things, and they had to pay tuition fees and a lot of money and all of that to gain skills and talents that would then allow them to be employed. Today, it's a lot easier to train yourself. If you have a modicum of knowledge and education, let's say, middle school and high school, after high school now, like, do you really need to go to college to learn the things that you need to learn? Not necessarily. The answer is not a resounding yes. Now there are other things you could go to. You can go to online courses, online schools, boot camps. You can do a variety of things to demonstrate that you have certain skills. And employers, I think, companies, on the flip side, people who are buyers in the labor market, they understand this as well, which is why a lot of companies are removing degree requirements, certain education requirements. I know Google and Apple, I think, removed degree requirements a long time ago, but I think a lot of other companies are following suit because they realize that is not just a product of where people went to school and their degrees. It's really a product of how individuals thought about their own education and how they went about training themselves and being ready for a continuously changing world. So the labor market is something that is very important for executives to understand, people who run companies to understand. And then finally, the third market is the capital market. And we touched on this a little bit earlier, but the capital market is important because lender savers need to generate return on their capitals, and borrower spenders need capital to run their businesses. And financial intermediaries like venture capital firms, private equity firms, connect those two groups. And understanding those flows and understanding what is working, what is not working, understanding what the considerations are of those three groups is crucial to being able to, for example, raise funds for your own company, which is something as a CFO that I do regularly, that I have because I have to. When a venture capital firm or a private equity firm is given a bunch of money by their limited partners, by the lender savers who provide them capital, who need to generate returns in their capital, these firms assess the broader environment and then make decisions on what kind of returns they need to deliver money back to their LPs and to meet their goals. And when returns become a lot harder to achieve, they tend to hold on to more of their capital. And then they are a lot more choosy about where they invest. And that's why you're seeing, for example, in the current trend, what you're seeing is some companies generating, fundraising a lot of money. So they're going out, they're fundraising a lot of money. And then a lot of other companies finding it very difficult to do so. And I think what's happening there is the VCs and the PEs, the investors, because the required returns now are higher than they used to be because rates are higher, they have to be choosy. And when they find, when they go through 20 companies or 30 companies, and then or 40 companies, and then they find one that will meet their requirements, they end up putting a lot more money into that one as opposed to that same amount of money in 10. And that's why you're seeing this lopsided distribution of fundraising. You've got a few companies that are generating so much cash that's oozing out of their ears, and then the rest of them are struggling because they didn't make the cut because the threshold is a lot higher. So then the question becomes, well, when does this change? And when does this get back to, when do we all get back to a place where the capital is being spread around more? And that's the million dollar question. In some cases, literally the million dollar question. So we'll see. But those are the three markets that, especially as a CFO in tech, I need to stay on top of: the product market, the labor market, and the capital market.
Yeah, I think it's super insightful, and I wanted to dive through that because I remember you articulating it absolutely brilliantly last time we talked as well. So I wanted to make sure that was on the that was on the podcast. But so I guess we talked about a little bit there about raising funds, and at the moment you've raised hundreds of millions of dollars in your time as well, and going through this time period right now where companies are sometimes struggling to raise this. What advice would you give to people to number one, founders and companies, but also CFOs like yourself who are looking to raise funds right now?
Yeah, well, I think the first thing is to be realistic, because the requirements, as I mentioned, for investors have changed. And what I'm seeing in some of the rounds that I pay attention to is investors will put in money, but they will require higher oversight rights. They will require liquidation preferences that they would not have required 3 years ago, 2x, 3x. They will require more security on their loans. The rates are relatively high because the overall rates are high. And so be realistic as a founder or as a CEO or as a CFO, be realistic that it's going to be difficult. It's going to be if you raise money, it's going to be on terms that are not as favorable as would have been 3 or 4 years ago. That's the first thing. I think the second thing is put on your thinking hats and get creative, because I think you have this interesting dynamic where requirements for investors are harder and terms are generally harder, but you have a lot of capital that's sitting there because of those hard requirements. A lot of capital is just sitting there, and different capital is held by different kinds of parties. So, you can get a little creative. You can talk to folks, outside the traditional venture capital, private equity. You can go to family offices. You can go to sovereign wealth funds. You have to be careful because their terms can be a little different as well. But there is capital to go after if you can be creative. Generally speaking, if you can stay bootstrapped during this time and be as efficient as possible so that you can last at least a year, if not 18 months to 2 years minimum on the capital that you already have, that's the best. That's plan A. That's the default. That's what you should do. And just wait for the markets to turn so that the cost of capital declines. And if you can't do that, then you get creative. I think if you have a solid business model that just got impacted by being at the wrong time at the wrong place, in other words, by still being young and unprofitable when the cost of capital skyrocketed, and you just got unlucky, then articulating that story, can be compelling if your strength in the product market is still there, and if you have still been able to keep your talent, which is your strength in the labor market. So that's why I think about those three markets, because really, if you could be strong in number one and two, that makes number three a lot easier. It makes raising capital a lot easier. I think your existing investors, you can go to them first. And now I'm talking brass tacks for tech founders, but you go to them first. If things are tough, ask them if they can provide a bridge round until you can do a bigger one in 12 to 18 months. Um, and ask them what metrics are required in this market. Generally speaking, for software companies, for SaaS companies that are small, um, pre-A, pre-B, the one metric that is more important than any others is net new annual contract value. The amount you're growing your contracts, the amount you're growing your revenue, how many new logos you're bringing on, how much annual contract value they represent, how fast and by how much is your ARR growing quarter on quarter. That's the number one metric. That's what investors care about, because if they see that you're unprofitable, okay. If they see that you're burning money, okay. That's almost a given for earlier stage companies. But if they see that in this environment, you're still able to secure new customers who are paying customers and you're still growing your revenue, then there's a conversation to be had. If you're not doing that, on the flip side, if you're not doing that, and so if you lay off half your employees, cut your burn significantly to conserve cash, but you're not adding many new customers or much new revenue, then that's the kiss of death. It's a long, slow death by a thousand cuts, because investors aren't interested in that. They understand that you're going to be unprofitable, whether you're 1 million in the red every month or 3 million in the red every month. What matters more is, are you growing your ARR? Are you growing your customer base? Are you growing your revenue? Are you penetrating the market that you've chosen? That's the most compelling argument. And then everything else can be worked out. I think that's where the companies that didn't pay attention to product market fit, that didn't pay attention or much attention to their competition, how to stay ahead of the game, and didn't get creative with their customers so that they can keep and expand their revenue, those are the companies that have a hard time. Whereas other companies that are also burning money, but they have all of the product market fit figured out and they're growing their revenue, they have a much easier shot of generating capital to survive in this environment. So that's something that I think people who run early stage tech companies should know.
Yeah. And again, it's super insightful, really, really insightful, because especially going back to them first two topics about having kind of everything in order to then go and raise to capital rather than just kind of cutting everything and hoping for the best. No, I think it's super insightful again. And another topic I always want to dive through with people like yourself, Karan, right? You've been through the craziest journey is taking a company public. That probably ties into a lot of the stuff that we talked about there, because I can imagine the stuff that you went through is all the learning curves that you probably just talked about to get the company to go public. But tell me about that story with SentinelOne.
Yeah, yeah. Well, you don't. When I joined the company, it was small, and every company has issues. Everybody knows that. Some issues are big, some issues are small, but that's what keeps it interesting. And the task of executives, and I wasn't a senior executive at the time I joined the company. I grew with the company, but I was exposed to a lot, and I worked very closely with the management team and with investors. And so, what I learned from there is everybody's job is to mitigate the problems, ignore the small ones so that you can focus on the big ones, and above all, support sales and support revenue growth. That's the most important thing. I think I used to have a boss who said that it doesn't matter what job you have, what department you work for. Your first job is sales, and your second job is whatever it is you were actually hired to do. And it's a important philosophy, because I saw it work out very well at SentinelOne. We hit our target every quarter for years, and for every quarter that I was there, at least. I don't know what's happened since I left. Of course, I'm not on the inside, but generally speaking, that was a great feeling. And so what I also learned through that, because in the companies that I worked before SentinelOne, they weren't as successful. They had different degrees of success. But SentinelOne was successful. And what I learned is to keep your employees motivated and to experience success, you need to do two things. One is win, and number two is don't be an a-hole. And that's it. I mean, it's really quite simple. I think some companies they spend a lot of time and energy trying to figure out their mission and their vision and their values and aligning all the employees on this and all of that. That's too complicated. It's not necessary. Um, I think it's important just to focus on the fundamentals, understand the market that you have chosen, understand where your product fits in the market, have a strategy on how to make your market presence stronger so that, and the metric that measures that is net new annual contract value, number of new logos, new customers, all of that jazz. And that is the definition of winning. And your employees, the number one thing that motivates them is winning. If you're not winning, then the rest of the things that you try to do don't matter, right? The keeping, having food in the office, giving them good benefits, giving them more vacation. None of that matters if you don't win. So you have to win. So that's the key. Win and don't be an a-hole. But there's a reason why win is number one and don't be an a-hole is number two. Because if it was in reverse, if don't be an a-hole is number one, it won't work because if you don't win, nobody's going to care if you're a nice person or not. Like nobody's going to care if you're kind or not. Everybody wants to win. And then on top of that, everybody wants to be good to their fellow employees and their colleagues. And that combination, I saw at SentinelOne, it's very powerful. The product was really good. The leadership was quite strong. They had picked a market that was highly competitive, but the reality was SentinelOne and its competitor CrowdStrike and other competitors in the market, but especially SentinelOne and CrowdStrike, they had refined and offered essentially next generation antivirus, but more advanced than that, in a very compelling way that replaced existing solutions. And so their customers, their prospects already had budget reserved for these solutions because they had been buying them from companies like McAfee and Symantec and others. SentinelOne came along and said, hey, you have budget. We have a much better product. Just switch them out. And that play was super successful. In other companies in cybersecurity, the key difference is that in some other companies in cybersecurity is that the budget isn't already there. And so you have to work extra hard to convince people to create budget for you. And that difference, it sounds like it's a minor difference, but it is everything. It is everything. It makes or breaks companies. If you have customers that already have budget for you versus customers who need to create budget, that can make or break you, right? And in SentinelOne, I saw, okay, they were taking advantage of people's existing budgets and they just offered a much better solution and they serviced that solution well. They had good customer support, good everything else that's meat and potatoes for enterprise SaaS, they did. But the key thing was they had a cutting edge product in a market where customers already had budget for it. And then everything else, my job, the IPO, but not just the IPO, but the fundraising rounds, the private rounds that we had before that, I think investors were ultimately bought into that reality. And that's what made it quite wonderful within cybersecurity, quite a wonderful story within cybersecurity. With respect to IPO, since you asked, what I learned from my vantage point and my job there was having very strong and long-term financial planning is absolutely key. So having a long-term financial model that you can use as a basis to have conversations with investors, understanding every line of the financials, understanding what contributes and what drives every line, and then understanding, the range of possible outcomes given a certain set of things that could happen with your company. Having a razor sharp understanding of that goes a long way in storing and building investor confidence that you know what you're doing and that your company will survive and thrive. And on the flip side, if you don't have those things, if you don't have a robust long-term financial picture, and if you can't articulate it, then investor confidence declines, and it doesn't take very long for your stock price to decline as a result. And so I think we've seen some companies where they drop the ball on certain things. They drop the ball on either planning for the future or in having a clear understanding of their own metrics. And then when the street got a whiff of that, that's all it takes. And people will sell their stock and invest it somewhere else in other companies where they have better confidence that the management team knows what it's doing. So that's the most important thing I think I learned from the IPO is having a clear long-term financial model is not just desirable, it is absolutely critical. Because at the end of the day, and I say this, people who say, you can't run a company from a spreadsheet, like tell them to talk to me because you totally can. And I think not only that, but it is imperative that you have that spreadsheet constantly refined, updated, and ready to go because you never know what will happen. Just as accidents happen to individuals, people, things drop on people's heads, people get into car accidents and whatnot. Accidents happen to companies. Sometimes things happen that you don't expect. And having a robust financial model where you can move things around and absorb the shocks is super important. So that's the main thing I learned.
Yeah. No, it's super interesting, and you kind of unpacked a lot there. But one of the things that stick out to me is number one, win, and number two, don't be an a-hole. But I always say that second place is the first loser, right? But yeah, which is pretty.
Absolutely. Yeah.
But I guess I want to just touch on that. You mentioned obviously running the company from a spreadsheet, obviously, but then also obviously having a real strategic long-term financial plan. How involved was you on that part? Because obviously running up to the IPO, it can get very stressful. There's not many businesses going public right now. But just tell me a little bit about that strategic plan and what would it look like for companies looking to maybe go IPO or public, sorry, next year?
Yeah. I mean, brass tacks, it's a 3 or 4 year financial projection that's relatively detailed, and you can share the high levels with your investors.
Mm-hmm.
Your income statement, your balance sheet, your cash flow statement, perhaps certain sub bills like the way you grow your ARR, your rate of growth, and some SaaS metrics because it's a SaaS company, so net and gross retention rates, churn rates, your average revenue per customer. I think some of those you would withhold because this is when you're going IPO, you're talking about public company investors and the street and whatnot. So you don't want to disclose anything that you don't have to, or that is not required, or that is not expected. And one thing you also have to keep in mind is once you disclose and present a certain set of metrics when you're going IPO, you will be expected to present those every quarter, which means that you need to have the calculation of those metrics and the recording of those things locked down, airtight, bulletproof, so that there are no hiccups in the future. And I think there are a few important things there. First is the choice of the metrics. And then the second is the defensible way in which you calculate them, so that it can be cross-referenced and recalculated by investors to make sure that they know that you're calculating the same thing, that it means something. I think some companies can make the mistake of disclosing too much, or disclosing the wrong things, or disclosing things that they themselves don't have a good handle on, but they think that the market expects them to disclose it, and so they do. And then later on, when some of those metrics go south or they make a mistake in the calculations, it can move the stock significantly. And so that's one thing that I learned that is super important when, from a financial perspective, when you're going public and staying public, because going public it's not just about the IPO. The IPO is a lot of fun. You go through a few months of writing your registration statement, getting your metrics in line, crafting the narrative and the story, then going on the roadshow, talking to interested parties who are interested in buying your shares, talking to analysts who work for banks and financial firms that will be, will be reporting their analysis of your results every quarter, and telling the world about it. And then of course we Sentinel One trades on NYSE, so we rang the bell, I think the closing bell, a couple of years ago. And so being in New York as a team for that, all of that is fun. But that's the dream, and then you wake from the dream when you're a public company and you have to report results every quarter and you have to meet expectations. And that's the part that I think ideally you want to be ready for a year before the IPO. And we did it pretty fast, so we weren't able to do everything the way we wanted necessarily. I think if I were to do it again, what I would do is a year before the anticipated scheduled tentative IPO, I would have started operating like a public company and have, quarterly, mock earnings calls in front of with our board and whatnot to get feedback, to have a beat and raise financial model, at least a year before the IPO, so we can track. Here's what we said we were going to do. Here's what we did, and now here's the new forecast that we give to the street, and constantly beat the expectations and raise the new expectations. Doing that for a year before the IPO would have been nice. We didn't do that because we didn't have time. And again, part of it is timing the markets. And when we went out, the markets were hot, and that's why when we listed, we IPO'd at $35 and it popped to something like $55, and then steady state. Of course, now it's a lot lower because everybody's a lot lower, but that's the reality. But having said that, yeah, I think preparation is key, and realizing that going public and staying public are two very different things.
Yeah. No, completely understand. You see a lot of vendors these days, especially with the market conditions being bought by PE firms and things like that. It's an interesting market for sure, Karan. But honestly, you've covered a lot of topics today, and I think it's amazing. A lot the way you articulate things is really interesting as well for myself and the listeners. And I certainly have learned a lot today. So I appreciate you coming on the show. And yeah, maybe we'll schedule one another time when the market's a little bit better.
Absolutely. Well, thank you, Elliot. It was my pleasure.
Awesome. Thank you very much. Bye.